Imagine the legendary trading floor of the New York Stock Exchange, a hive of energy, shouts, and lightning-fast deals. For more than a century, this place has symbolized the power and tradition of global finance. But now, something unprecedented is happening. A digital revolution, fueled by a new breed of assets and a tidal wave of technological innovation, is quietly slipping into Wall Street's world, one coin at a time. This year, Nasdaq has made a move that could shake the very bedrock of both traditional finance and the cryptocurrency universe. In June of the year 2025, Nasdaq formally submitted a proposal to the United States Securities and Exchange Commission, or SEC, that could forever change how the world's largest investors interact with digital assets. What if, for the first time, institutional giants could access not just Bitcoin or Ethereum, but also an entire array of alternative digital currencies, using simple, regulated investment products? What would it mean for portfolios on Main Street and Wall Street alike? Let's take a step back to understand the stakes. For much of the past decade, Bitcoin and Ethereum have dominated the conversation. They are the twin pillars of the crypto landscape, representing the lion's share of market capitalization and media attention. The launch of the very first Bitcoin Futures Exchange-Traded Fund, or ETF, in October of the year 2021 was a watershed moment, amassing over $1 billion in assets in its debut week. This event signaled a slow but steady opening of the doors between the world of crypto and the world of traditional finance. The pace has accelerated dramatically since then. When BlackRock, the globe's largest asset manager, entered the crypto ETF arena in the year 2024, the effect was immediate and dramatic. A surge of nearly 30% in overall crypto ETF assets under management within just 6 months. These numbers reveal a powerful undercurrent of demand. But until now, the menu for institutional investors has remained incredibly limited. If you wanted exposure to anything beyond Bitcoin or Ethereum, you had few choices. Most investors either faced the daunting task of navigating unregulated exchanges, rife with security risks, legal uncertainty, and wild price swings, or they had to stay on the sidelines. The result? As of June in the year 2025, institutional ownership still accounts for only about 7% of all crypto ETF assets. The vast majority of institutional capital has been waiting, cautious perhaps, but certainly alert to the possibilities. Most existing products are restricted to the two big names, Bitcoin and Ethereum. Yet the world of digital assets is far more diverse, and its evolution is accelerating. Enter the altcoins, alternative cryptocurrencies with unique value propositions and rapidly advancing technology. Take Solana, for example. Its daily trading volume has jumped 40% since the start of this year, surpassing the $10 million average daily volume threshold that Nasdaq requires for index inclusion. Or look at XRP, which recently achieved a level of regulatory clarity that few digital assets can claim. A federal court decision in April of this year reaffirmed that XRP does not qualify as a security. This ruling removed a key legal barrier and opened the door for much broader adoption by financial institutions. Cardano and Stellar, two other ambitious blockchain projects, have also matured. Cardano is known for its focus on academic research and peer-reviewed development, while Stellar has carved out a niche in cross-border payments, enabling fast and inexpensive transactions across the globe. Together, these four altcoins, XRP, Solana, Cardano, and Stellar, represent a new frontier in digital finance. Their combined market capitalization now exceeds tens of billions of dollars, and each meets Nasdaq's rigorous criteria for index inclusion, a minimum $500 million market cap and robust daily trading activity. Recognizing these trends, Nasdaq filed a pivotal rule change proposal with the SEC on June 2, 2025. The proposal seeks to add these four altcoins to its flagship Nasdaq Crypto Index, or NCI, which already underpins the popular #Nasdaq Crypto Index ETF. If this proposal is approved, the ETF would for the first time be allowed to include all 6 major digital assets: Bitcoin, Ethereum, XRP, Solana, Cardano, and Stellar. The SEC's decision is expected by November 2nd of this year, a moment that could prove to be a turning point for crypto markets worldwide. Why does this matter? For one, it promises to reduce the stubborn tracking errors that have plagued crypto ETFs. Until now, regulatory restrictions have forced ETFs to mirror only a portion of the full index, undermining investor confidence and creating performance discrepancies. With all 6 assets included, ETF managers could more accurately replicate the index, boosting trust and potentially unlocking new flows of capital. But this is not just a technical adjustment. It's a signal of mainstream acceptance for altcoins. Cathie Wood, the visionary behind ARK Invest, puts it plainly. Altcoins represent innovative technologies and offer significant growth potential for investors willing to embrace higher risk. These assets are no longer just speculative plays for tech-savvy traders. They are becoming integral parts of diversified investment strategies. In fact, the correlation between Bitcoin and many altcoins has diminished by 15% over the past year, indicating that these assets are increasingly moving to their own rhythms, offering new diversification opportunities for sophisticated investors. Yet the road ahead is fraught with challenges. Legal and regulatory uncertainty remains a powerful headwind. Michael Green of Ledger Prime warns, including altcoins and ETFs could destabilize the market due to their inherent volatility and lower liquidity. Unlike Bitcoin and Ethereum, which boast deep liquidity and global recognition, altcoins can experience sharp price swings, especially if a sudden influx of institutional capital triggers rapid buying or selling. Liquidity and custody are also major concerns. Crypto ETF custody solutions typically involve a combination of cold storage, protecting assets from hacks by keeping them offline, and multi-signature authentication, requiring multiple approvals for transactions. But as new assets are added, these systems must evolve to handle greater complexity and higher stakes. The SEC is acutely aware of these risks, as seen in its cautious approach to spot Ethereum ETFs, which it extended into the third quarter of this year for further review. Legal experts like Jake Chervinsky point to a broader climate of uncertainty. The SEC's inconsistent regulatory stances create a climate of uncertainty for applicants and investors alike, he explains. Applicants are often left guessing about the agency's next move, complicating product development and investor decision-making. On the other hand, Paul Grewal, the chief legal officer at Coinbase, argues that XRP's recent legal clarity now positions it as a much more appealing asset for institutional investors. This split between progress and hesitation defines the current moment. So what's at stake if the SEC gives Nasdaq the green light? Imagine, almost overnight, altcoins such as XRP, Solana, Cardano, and Stellar becoming core holdings in Wall Street portfolios, accessible through regulated, transparent, and relatively low-cost ETFs. For many, this would be a historic inflection point. Anthony Scaramucci, founder of Skybridge Capital, is optimistic. Crypto ETFs will democratize access to digital assets and propel mainstream adoption. He sees this as the opening act for a future where digital assets are as ubiquitous in portfolios as stocks or bonds. The impact could be profound. Analysts predict that full approval would trigger a wave of institutional inflows, potentially some of the largest the crypto market has ever seen. This would not only improve liquidity for the newly included tokens, but also encourage further innovation in crypto product development. Other index providers and fund managers might be inspired to follow Nasdaq's lead, accelerating the integration of digital assets into traditional finance. However, not everyone is convinced that the floodgates should open without caution. Michael Green cautions that the volatility and sometimes thin liquidity of altcoins could amplify market swings, especially if billions of institutional dollars rush in suddenly. Solana's recent 40% spike in daily trading volume illustrates both the growing interest and the elevated risks. If the infrastructure for trading, custody, and risk management cannot keep pace, the result could be market instability or even systemic risk, a point echoed by former Federal Reserve economist Linda Zheng, who stresses the need for robust regulatory frameworks. Let's also consider the possibility of a more measured approach. The SEC could grant conditional approval, allowing altcoins into ETFs, but imposing strict requirements for custody, transparency, and risk controls. Such an outcome might slow the pace of inflows, but it could also lay a more stable foundation for long-term growth. Conditional approval could include mandates for real-time audits, enhanced investor disclosures, or even caps on allocation to the riskiest assets. On the flip side, if the SEC rejects the proposal or delays its decision, the consequences could be equally dramatic, but in the opposite direction. The enthusiasm that has been building across the financial sector could evaporate almost overnight. Investors and product developers might pull back, reinforcing the existing divide between Bitcoin, Ethereum, and the rest of the crypto universe. The message would be clear: regulatory hurdles remain, and the road to broader acceptance is longer than hoped. For investors and tech enthusiasts watching from the sidelines, the coming months will be critical. If altcoins gain index status and ETF exposure, expect to see liquidity and volatility surge. This means greater opportunities for profit, but also greater risks of losses. As Cathie Wood reminds us, altcoins offer significant growth potential for investors willing to embrace higher risk. Now is the perfect time to brush up on how ETFs work, learn about market cap weighting, and understand the nuances of crypto asset custody. It's also crucial to stay informed about regulatory developments. Jake Chervinsky urges investors to follow SEC filings and subscribe to trusted news sources, as regulatory shifts can happen quickly and with far-reaching consequences. Understanding the mechanisms behind ETF expense ratios, currently averaging 0.75%, and storage solutions can help you make smarter, more informed investment decisions. Don't overlook diversification either. Nasdaq's modified market capitalization weighting is designed to spread risk across multiple assets, rather than concentrating it in just one or two. This approach could help investors weather the inevitable storms in the high-volatility world of crypto. Study how different assets are weighted and managed, and consider how your own portfolio might adapt if altcoins become more accessible through regulated products. Let's not forget the broader context. As of June this year, institutional investors still control only about 7% of all crypto ETF assets. In other words, the vast majority of capital remains on the sidelines, waiting for regulatory clarity and better investment vehicles. If the SEC approves Nasdaq's expansion, it could unlock a tidal wave of new money, potentially the largest in crypto history, reshaping the market landscape almost overnight. Looking ahead, several scenarios are possible. In the best-case outcome, the SEC grants full approval, and we witness a massive influx of institutional capital into newly accessible altcoins. This could legitimize these assets in the eyes of both Wall Street and Main Street, further breaking down the old silos between traditional and digital finance. In a more cautious scenario, the SEC opts for conditional approval, requiring robust safeguards and transparency measures, a slower but perhaps more sustainable path to mainstream adoption. And of course, there's always the risk of outright rejection, which could set back the altcoin movement for years and reinforce the idea that only Bitcoin and Ethereum are suitable for regulated investment products. So, what does all this mean for you? Whether you're an investor, a technologist, or simply a curious observer, this is a story worth following closely. The balance between risk and regulation will determine whether crypto's next chapter is marked by stability and growth, or by renewed volatility and uncertainty. The next few months could set the tone for digital assets for years to come. Here's the bottom line. Wall Street's readiness for rapid altcoin integration depends on getting the balance right. If proper safeguards are in place, the flood of institutional money could stabilize altcoins and legitimize them in the eyes of the financial world. But move too fast without clear rules, and we risk repeating the mistakes of past market bubbles, a lesson regulators and investors are keen not to repeat. And here's a final secret most people miss. With institutional ownership of crypto ETFs still under 10%, the majority of capital is on the sidelines. The next SEC decision could open the floodgates, unleashing unprecedented inflows and redefining what it means to invest in digital assets. So, what do you think? Are we witnessing the moment when altcoins finally break into the financial mainstream, or are there dangers still lurking beneath the surface? Let us know your thoughts in the comments. And if you want to stay ahead of global economic shifts and cutting-edge tech stories, don't forget to like, subscribe, and hit the bell. The next